Hey, when I sat down to write the script for this video, I had a simple idea in mind. A basic episode about core financial concepts and statements. The balance sheet, the income statement, cash flow. But while I was preparing it, I was genuinely surprised to discover that one of the most elementary examples we'll walk through later turned out to be too much for experienced finance professionals. Well, experienced. I used it as a take-home test for job candidates during interviews. Analysts, their managers, people with years of experience behind them. At least that's what their resumes said. Job titles, companies, all pretty serious stuff. And this is going to be a genuinely simple example. My point is, let's say this episode is for aspiring finance folks, or even people who aren't in finance at all, so we can speak the same language. But with all due respect, and with a bit of courage, I'll suggest that even some seasoned finance professionals might find it useful to refresh their memory here.
So I have two goals. First, cover the basics. Naturally, as we go through these fundamentals, you'll probably have a ton of questions. That's great. Drop them in the comments, I'll do my best to answer, and for the most interesting questions, we might even film some extra material for the channel. So don't hold back. Second goal, I keep running into the fact that even experienced finance people don't always understand the substance behind theory they memorized long ago, or the relationships between key metrics. We get so used to running on autopilot with established formulas. Grab this number, plug it in there, drag the formula down, that we lose sight of what we're actually doing. So my goal is to connect theory with practice from the perspective of a working finance professional, explained simply and practically, straight from the source.
When people talk about business, the most common recurring terms are revenue, profit, and financial stability. You've all heard these 100 times. The first two relate to the income statement, often called the P&L, profit and loss statement. Financial stability is about the balance sheet. And cash flow, well, everyone just says cash flow, so we'll stick with that. Let's start with the P&L. Across industries, its structure looks roughly the same. The simplified P&L structure you'll see on screen is typical for, say, retail and manufacturing companies. But for financial institutions, say a leasing company, it looks different. Everything is built around interest and other income from lease payments, while the expense side is made up of interest expense on borrowed funds and various other line items. But in any case, a P&L always has a revenue side and an expense side, followed by taxes.
Why do we need an income statement? You'll say, to understand how much we're making. That's correct, but it's a pretty academic answer. From a professional standpoint, the P&L shows how efficient a business is, how well it adapts to change, and to some extent, whether there's room to grow. Let's go through this step by step, starting again with the basics, fixed and variable costs. At first glance, this seems simple. Say we're in the business of selling tomatoes. We buy a pound for $1, sell it for $1.50. We buy 2 pounds for $2, sell them for $3. The more tomatoes we buy, the higher our cost of goods, and vice versa. So the cost of buying tomatoes is our variable cost. It moves with sales volume. Makes sense. Moving on. To store the tomatoes, we need a warehouse. We rent a small space that holds, say, 50 pounds of tomatoes, regardless of how much we actually bought or sold. We have to pay for that warehouse no matter what. That's our fixed cost. Now let's do the math. If we make 50 cents per pound, we need to sell at least 20 pounds to cover the warehouse rent. That's our break-even point. And this is where we get into pricing and trade terms. Is it better to sell a pound with a 50-cent margin or 10 pounds with a 30-cent margin? Let's not get sidetracked. We're talking about costs right now. Pricing will be its own episode.
Here's a chart. Seems simple enough. And someone might ask, why spend so much time on this? Here's why. When times get tough and sales drop, we need to cut costs. In that situation, is it better to have more fixed or more variable costs? Obviously more variable, because as sales volume falls, costs fall right along with it. So we go looking for ways to pay for storage based on the space our product actually occupies, rather than the whole warehouse, meaning we only bring in tomatoes for confirmed orders. We try to turn fixed warehouse costs into variable ones. The same goes for other expenses. For example, a sales manager gets taken off a fixed salary and put on commission. And the opposite happens when business is booming.
a high share of variable costs becomes less advantageous, so we put managers back on fixed salaries, which boosts overall profit. Total savagery, I know. I think I just turned every sales manager in the country against me. But of course I'm exaggerating, though in general, that's exactly how it works. In the textbooks, this is called operating leverage. There's another kind of leverage too, which I'll get to a little later.
So the point of all this, remember, the P&L isn't just about the size of the profit, it's about managing that profit, meaning business efficiency and adaptability to change, specifically changes in the external environment. And the finance person's job is to spot opportunities and threats in time and respond to them. What else do we look at in a P&L? The cost structure, including how it varies by industry. Obviously, a travel agency and, say, a steel plant will have very different cost structures. We already touched on this when discussing the mix of variable and fixed costs. But industry-specific cost structure matters too. You can't put a factory worker on commission, but a tour sales rep? Sure, why not? There's also the trend by line item to watch. If administrative costs keep climbing year after year, that means headcount is bloating, and it's time to think about restructuring. We've got a whole separate video on that on the channel. I'm sure every annoyed sales manager right now is about to go watch it.
One more thing. It's important to study the P&L not just as a whole, but broken down by category, brand, or product line, looking at how cost of goods or production links up with logistics, marketing, interest expense, and so on. Simple example. I buy tomatoes from 3 different suppliers, and one of them has noticeably more expensive logistics. Say it's hard to schedule freight, we end up trucking everything, and the loss rate during transport is higher. The product itself is cheaper. Great, seems like a favorite supplier. But logistics eats up the whole margin in that particular case. And often, logistics costs sit on a totally separate line, with the commercial team saying, that's not on us, that's the logistics guy's problem. At the level of total cost of goods, it might not even be visible. But if you dig deep enough, it's easier to drop that supplier. Even at some cost to volume, it beats dragging along inefficient logistics. You walk in, lay out the numbers for the commercial team, they hate you for it, but facts are facts. That's the kind of detail worth watching for in a P&L.
If interest expense is rising, it means we're either borrowing more or the cost of borrowing is going up. On its own, that's not necessarily a red flag. Maybe we're actively expanding production capacity. But you have to understand, if market conditions turn negative, we could run short on cash to cover interest payments, and that's a real problem. And on the flip side, if my interest expense is tiny relative to EBITDA, that means I'm not fully using the borrowing capacity that could help me grow the business, like offering more extended payment terms to customers to gain an edge over competitors, or buying raw materials with upfront payment in exchange for a bigger discount, boosting profit that way. By the way, there's a metric called the interest coverage ratio, EBITDA divided by interest payments. As a rule of thumb, EBITDA over a period should exceed interest payments by at least 2 to 2.5 times. In calmer times, this ratio averaged around 4.5x for corporate borrowers broadly.
By the way, a business's ability to grow revenue and profit through borrowed money is called financial leverage, another tool for managing company performance. But it's worth remembering you can overdo this kind of leverage too. At some point, every additional dollar of revenue starts generating less and less profit, and eventually turns into a loss. That's the law of diminishing marginal returns. Hello, freshman year econ. I'm bringing that up to make the point that basic academic concepts from your first year of school genuinely hold up in practice. You just need to know how to apply them. What else do we look at in a P&L? The cost structure of our competitors to figure out how well we can compete with them tactically and strategically. Naturally, the question comes up, how do we even know their numbers? Turns out it's pretty easy to estimate a competitor's costs if we're talking about similar products. We know where they source materials, where it's shipped from, roughly how many people they employ.
Good. We've covered the P&L. Let's move to the balance sheet. At the very least, the word itself is familiar to everyone. Let's talk about what it actually means. I'll start with 2 terms you've definitely heard: assets and liabilities. Even professional accountants sometimes struggle when you ask them directly. They'll list off the components, but can't really explain it clearly. So here's the deal.
Liabilities are where the company's money comes from. Assets are what the company does with that money. What you see on screen, obviously, is a highly simplified balance sheet. There are more line items in reality, but this covers the basics. And it's obvious that assets always equal liabilities, because you can't have more property than the sources of money used to acquire it. And the reverse holds too. Even if a company suddenly received something for free, like a gift, that gift shows up as an asset, and its value shows up on the liability side as retained earnings.
Third, the turnover of short-term assets and liabilities. Example, buying raw materials and manufacturing the product takes 2 weeks. The product sits in the warehouse for another week, then a week to ship to the customer. Plus another 2 weeks of payment terms we extend. That's 6 weeks total. This is called the operating cycle. So any bank loan should have a repayment term no shorter, ideally longer, than those 6 weeks. Otherwise, you're looking at default, with all the consequences that come with it. In other words, you have to balance your assets and liabilities, hence the name balance sheet. And fourth, overall leverage. If equity is positive but small and debt is an order of magnitude larger, lending to that company is probably risky, though of course you need to look at the details. All of this together is what's called financial stability.
Let's see how this plays out in practice. In front of you is the real balance sheet and P&L of a well-known regional US retail company. Let's try to answer, how efficient is this company? How stable is it? And what's likely coming for it in the near future? In order, the company is profitable, but profit is small relative to revenue. Okay, that happens, depends on the industry. But over the past year, the company doubled its revenue, while the bottom line stayed almost the same. That's a red flag. The company saw a significant drop in profit per unit sold, and if that's a market-wide issue rather than something specific to this one company, and as it turns out, it is, we can assume that without doubling revenue, the company would have gone into the red, and possibly wouldn't have been able to cover its interest payments.
Now, let's look at the balance sheet. Right away, the heavy debt load jumps out. Out of total liabilities of over $500 million, equity, capital plus retained earnings, is only $85 million. That's thin. Moving on. Fixed assets, meaning long payback assets, total nearly $300 million, while long-term debt plus equity only cover $155 million, half of that. The rest is financed through short-term borrowing and payables, meaning it's the banks setting the terms here, and if regular creditors run into trouble, the company defaults, meaning it can't meet its own obligations. One more thing. With revenue doubling, administrative costs stayed exactly the same, meaning the same headcount is now doing twice the work. Fine for a year, but eventually they'll need to hire people, set up more workspace, meaning EBITDA will drop, which again threatens the ability to cover interest payments. Let's recall how much EBITDA should exceed interest payments. Here, it checks out. The ratio is 4x, but margins are thin. So tomorrow, EBITDA drops, and there you go. So to answer our questions, how efficient is the company? Answer, not efficient. Revenue is growing while profit stays flat, and it's obvious EBITDA is going to shrink. How stable is the company? The balance sheet tells the story. This company is walking a tightrope. The smallest shift in bank or creditor policy, and it's in serious trouble. What's coming?
This was a very simplified example, and real credit analysis takes into account a lot more factors. We're not trying to go deep into that here. We'll cover credit analysis and risk management in a separate video. Right now, the goal was just to illustrate the process of analyzing a balance sheet and P&L together. And now, here's the kicker. This might seem simple and obvious, but this exact exercise is what I gave to more than a dozen job candidates during interviews. These were people at various levels, including from major banks, leasing companies, and large national firms. And you know what? Out of a couple dozen candidates, only 2 managed to work through this elementary analysis, and even they weren't fully confident. My point in sharing this, so you don't end up looking clueless in an interview or at the office, pay attention, listen, ask questions in the comments, and keep.
Now, here's one of the key ideas that's going to run through everything else I put out. Brace yourself. Cash flow is the single most important concept for anyone in finance. Let's think about it. Can a company exist with strong profit but no cash? The answer is no. Say we buy cheap with upfront payment. Great. And sell high on extended terms. Also fine. But then the cash runs out, and we need to buy that same profitable inventory again to sell it high once more. No problem. We go to the bank, borrow, buy cheap again, sell high again. Everything's great. But now we owe the bank interest, not even the principal yet. And meanwhile, our customer still hasn't paid for what we sold them on credit. Their terms haven't expired. But the bank is already calling the loan because we breached a covenant. And now there's no cash again. That's it. We're bankrupt, even though the business shows a profit on paper.
So cash flow, the movement of cash, is the single most important element of financial reporting. To put it dramatically, cash is the lifeblood of a business. But cash flow is affected by a whole range of factors that also show up in both the P&L and the balance sheet. So there's an organic relationship between all three financial statements. The P&L shows business efficiency, adaptability to change, and to some extent, the potential for growth, all measured over a period of time, whether a year, a season, and so on. The balance sheet gives you a picture of financial stability, historical performance, and the ability to keep operating in the near term. Since it's prepared as of a specific date, it shows things at that single point in time. And cash flow helps us plan payments for ongoing operations using the direct method, or for investment projects using the indirect method. That's it for this one. Drop your questions in the comments. See you next time.